Well, at ET Now, we are committed to help you reach your financial goals. India is a land of opportunity, and the best way to really reach your financial goals is to participate. Today, we've partnered with the Union Bank AMC, and we would be walking our viewers through the benefits of long-term wealth creation. How? By taking a simple step, a small commitment called systematic investment plan, you can really do magic to your future wealth creation. So to talk about this simple magic of long-term planning and SIP, how it can really create wealth and how the power of compounding can work with you, I'm now joined by the CEO of Union Bank AMC and the CIO of Union Bank AMC. Gentlemen, good to have you and thank you for joining us. Mr. Kumar, let me first talk about your positioning. Your positioning is that you are one AMC in a very crowded market. You managed to become 4,000 crore in a crowded market.
Yes.
How did you achieve that?
So, Nikunj, while the industry has grown and hit a level of say 28 lakh crores of assets under management, I think we have only scratched the surface. There is a long way to go. And I'll give you a simple, statistic to establish this point. So we, as a relatively young AMC, in a very competitive market, we have managed to add a significant number of new first-time investors to the industry. So on an average, about say 65 to 70% of our investors tend to be first-time investors in mutual funds. We can understand this because we do their KYC. Okay, and in terms of the assets under management, you would think that our market share is relatively low. But in terms of the number of unique investors in the industry, see, there are more than 2 crores investors in the mutual fund industry, unique investors. We have a market share of more than 1%. So we have demonstrated that even a young AMC, by focusing its effort on reaching out to newer investors, newer markets, going beyond the larger cities, would be able to expand the market, find a niche for itself and grow. So we never believe that we are competing with 40 or 44 other AMCs.
5 years ago, it was difficult to convince an investor to start a SIP. Now the investor, when we meet the investor, they are perhaps asking you that why not one, why should we not start 2 SIP? Why suddenly, and touch wood, there is a marked improvement in this entire SIP collections?
I think this has been one of the best things to have happened to our industry. And now SIP is established as a separate product category. Many people think that SIP is not even mutual fund, that it's a separate product. And I think we have to thank a lot of people for that, starting with the regulator, starting with AMFI, with its strong campaign, pushing SIPs, mutual funds, IA, etc. Individual AMCs, the financial advisors.
How about few good words from media also?
Absolutely. I think ET Now has been at the forefront of this. So we must compliment, everybody in this ecosystem who have pushed this concept. And ultimately, see, when you build up some concept like this, you reach an inflection point where the value of the whole concept becomes very clear to people. So SIPs really took off once people realized that they have actually made a lot of money with SIPs. No amount of talking can convince people. Ultimately, the proof was in the pudding.
When an example which I classically see on TV is that pizza is instant gratification, dal makhani is delayed gratification. The millennial today wants a pizza which is instant gratification. SIP is like a dal makhani where you get delayed gratification. Is this the right product suitable for a millennial?
Absolutely, this is a great product for a millennial, or in fact most other people who intend to save for a long period of time. Simply because this is like a forced savings, because till the time you have something like SIP, you would not want to save or you want to spend. Especially since you talked about millennials, we have seen increased level of spending culture in the millennials. So a lot of them are actually taking loans for consumptions, etc. In that case, if they start saving money through SIPs, it will actually build up a great habit of savings, and this is a especially good product for millennials, I would assume.
So Vinay, my immediate question is that SIP is supposed to be, it's a planning, it's a decision, it's a lifestyle. 10 years I think is a reasonable time, but if I look at the performance of Nifty, I'm not looking at a mutual fund, the performance of Nifty in last 10 years, which is from 2010 to 2020, gold and Nifty have almost given similar returns. So how would you defend this?
So I would say that it's actually a difference of asset class. Gold as an asset class is the value of gold is simply the value of the fear which you have as an investor, fear about devaluation of global currencies, fear about global monetary system, so on and so forth, which you, I or anyone else cannot predict. In the last 10 years, all of this has helped gold, especially since most of the central banks have been devaluing their currencies, they have been resorting to quantitative easing, etc. However, equity as an asset class gives is based on real earnings, and earnings can be discounted. Earnings have real value, and especially remember, as interest rates fall, the value of those earnings keeps rising. So especially in this current low rate environment, which we don't know it will remain till when, but in this low rate environment, equity as an asset class is an extremely attractive asset class for investors. And I would say that it would not be a very wise decision to over allocate to asset classes like gold. Equity should be a meaningfully large asset class in most investors' portfolios.
Now, process over people. Processes are driven by people. Your performance in the last couple of quarters has improved dramatically across categories. Why, and is this sustainable?
I think that's a good observation. In fact, our performance over the last 2 years has improved very significantly, to the extent that today, except one, all of our equity and hybrid products is above average, beating the average peers. Even our fixed income funds are doing quite well. So the basic reason has been that we have put in place a very robust process, and now anybody can claim that they have a process, but the real key thing is that we follow the process diligently. Now, the way to demonstrate that we follow the process is to really show that funds are performing consistently well. Our objective is that our funds should be consistently above average in its category. Now, except in one fund, which will also soon change, I'm sure, all other funds have moved above average from a rather negative situation earlier. What we believe in is that as a fund manager or as a fund house, we are not in a position to indicate what our rank will be, what our returns will be, because that depends on a whole lot of factors. What is really in our control is the process. How do we select stocks? How do we create a portfolio? This is what is in our control. Process can be replicated. Your returns and your rank may not be, you may not be able to replicate, which is why we have emphasized that, it is a process that is of paramount importance. People will follow the process, and the process will deliver consistent returns. So this is the method that we are following, and the last 2 years it has worked brilliantly for us.
What have you changed in terms of a process? Can you be more specific?
Yes, of course. So on the equity side especially, what we have done is we only look at stocks which have a minimum market capitalization of 500 crores, because we believe that stocks below that tend to be under researched, not easy to get information, and tend to be very liquid also. And we typically run open-ended funds, so we need liquidity. And then we apply 3 filters: business, management, valuation. But the stocks which pass these filters get into our fund house universe. So we today have close to 160 companies in the Union Mutual Fund universe. So any of our funds, the fund manager can choose a stock only from this universe, which ensures that before any of our fund managers picks a stock for any of our portfolios, that stock would have gone through a rigorous filtering process where the entire team looks at it, debates, and finally a call is taken. So we don't take calls on the basis that fund manager comes in the morning and thinks that, oh, this stock looks good today. No, we don't do that. So the process is very rigorous, and we don't make even one deviation from that.
When you do financial planning, you have to plan for years and think in terms of decades. So what is going to be the differentiating factor for Union Bank AMC in this decade?
So we have a very exciting future ahead. I'll tell you why. So first and foremost, you would be aware that Union Bank network is going to get wider because Union Bank is joining hands with two more public sector banks sometime in the near future. So this will give us potentially a much larger network of branches, more potentially more investors, etc. So that is one thing which can give us a very powerful distribution machinery. That's one part. Second is we have a very solid partnership now with Daiichi. Daiichi Life of Japan hold 40% stake in our company, and that has really given us a lot more stability, more relevance in the market. We are very well capitalized today, and importantly, it has also opened up a new line of business for us. We have started an offshore fund with Daiichi, and this is a very, very interesting potential line of business, because internationally there is tremendous liquidity, and if we are able to demonstrate value with our fund, see, whether it's in India or internationally, ultimately investors look for value. So if we are able to deliver value, we believe that not only in the Indian market, even in the international market, we should be able to make our presence felt, particularly with the support of Daiichi. We have started with one offshore fund. I expect that in 5 years' time, our offshore business could be actually larger than our mutual fund business.
What role do you think distributors will play? Because now there is a debate about the importance of distributor, and now SEBI or the regulator is very keen that the direct channel really increases.
So the direct channel is fine. See, there are a lot of good things in the market, in life. Not everything is good for everybody. So direct channel is great for people who are well informed, who have the resources and the time and the inclination to do their own research and make investment decisions. They should go direct by all means. But the vast segment of our society, and we are talking about a market where the retail penetration is still extremely low by international standards. In such a market, you have hundreds and thousands of mutual fund products. How does a retail investor choose a particular fund? And it's not limited to just choosing a fund. See, why do you invest in mutual fund? Because you want to meet certain goals in life, whether it's education or buying a house or retirement, whatever. So how can you create a good financial plan to achieve your goals? And this is something in which an expert can always help you. So if you are a retail investor, you don't have the time or the resources to do your own research. It is always good to seek the help of a distributor or an advisor, by whatever name it goes.
Where are you on this large cap versus mid cap debate?
So once again, in judging the valuations of large caps versus mid caps, we resort to our in-house investment process, which looks at fair values of both these segments. So as we speak, we see that broadly both these segments, large caps versus mid caps, are yielding almost similar potential returns over the next 5 years. And hence, our view is neutral across both large caps and small and mid caps. Also, what we do is we do various quantitative analysis to cross-check our internal research. So for example, recently what we did is we looked at what is the value of Nifty 50 within total Nifty 500 stocks, and how has this moved over the last 20 years. So that would tell you about this polarization debate.
Mr. Kumar, we tend to ignore as investors the importance of this 4-letter word, risk. When the going is good, everything looks good. When the going is bad, nothing looks good. What is the risk at the current juncture for a debt and equity investor? And let me supplement this with one simple point, which is interest rates. Last 10 years, interest rates have come down everywhere. Negative interest rates, a terminology which I never thought would exist, but it's actually true. If interest rates, they start inching up, or if interest rates don't go lower from here, is that the single biggest risk for investors, whether it's debt or equity?
Well, in my view, Nikunj, the biggest risk for an investor today is not to remain invested in the market, whether it's debt or equity. Okay, our view on both debt and equity are positive. On interest rate, we have a view that for a variety of reasons, interest rates are likely to come down in the near future, both in the long term and the short term. There's already been a rally and we expect that to sustain for some more time. On the equity, Vinay has already explained that we have a positive view for the medium to long term view. So there is always a risk in doing something, but we are at a juncture in our evolution in the market where the bigger risk is if you miss out the market. See, it's like being in the game. To make money from the market, you need to be invested in the market. People who watch from the sidelines, they will only keep watching. You never know when the market will start rallying, when it will turn around, when interest rates will move, etc. These are difficult to predict. We have an idea of we have a view on the general direction. But it's important that you stay invested. In the last 25 years, I believe personally you have been a beneficiary because you have stayed invested with one fund house and you have seen the benefit. So the most important thing for investors is to start investing as soon as possible.
So then why do people keep on jumping out of schemes? If distributors who are well informed messengers, why do we see so much of churn within the mutual fund industry? Every SIP investor, at least I have personally interacted with, they've told me they had schemes in A, AMC. After 3 years, they'd moved to B. After 3 years, they moved to C. And after 15 years, it's A, B, C, D, E, F, G.
So this is a mistake which many investors make.
But they get advice from distributors.
Sometimes yes, sometimes no. Like in any field, you have the experts and the better people and the mediocre people in any field. I don't think any good advisor, a genuine advisor, would tell his or her investors to keep switching from fund house to fund house. But we normally give two general principles to most of our investors. In your equity portfolio, please don't diversify too much. Stick to maybe 4 or 5 funds. That's good enough. It will give you the necessary diversification. If you over diversify, you will end up buying the whole market and your returns will be less than market returns. On fixed income side, we advise people to diversify aggressively as much as they can across fund houses because the upside is limited. Fixed income is not going to give you 25, 30, 40% return in any year. And the downside can be severe when things go wrong. It is very important that at your portfolio level, you diversify and individual securities have only a small exposure in your portfolio. So diversify aggressively in fixed income and stay focused with 4 or 5 funds in the equity side. That's very important. But coming to the churning side, some of it might have happened in the market, but I would like to quote Charlie Munger, show me the incentive, I'll show you the outcome. So today, fortunately, I think largely thanks to the efforts of SEBI, there is really no incentive for any distributor to engage in churning.
Gone are those days.
We don't see that happening at all.
Okay. So when I'm going to close it up with one very simple postmortem or market analysis, which is that India is a $3 trillion economy. For a $3 trillion economy, if I look at the equity participation, both direct or indirect, it is less than 10%. What do you think is been the issue? You've spent more than 25 years in the market. What do you think Indian investor lacks? Is it discipline? Is it understanding, which we are trying to change, because of these shows? Why is that India, which is a growing economy, the romance is young population, we are the fastest growing economy in the world, yet the level of investments for an ordinary Indian saver, either it's gold or real estate, it is not equity or mutual funds. Why is that?
So I think partially Nikunj, you have answered that question. It has to do with financial literacy. It has to do with a level of comfort with financial investments. And thanks largely to regulators, to media, of course, of course media, and also demonetization, which was one of the big master strokes, which resulted in a large number of people looking at financial savings. People have now warmed up to this entire concept of mutual funds as an investment product. And because of this, we have seen a significant surge in participation of retail investors in equity as an asset class. Over a period of time, we think that as people see the benefits of this in their own portfolios, in their net worths, this will automatically feed on itself, as we call it as the positive feedback loop.
Yes.
When people see that, they would automatically start to invest more, and they would see the benefits of investing in a product which is liquid, which gives them tax benefits, which gives them higher returns over a longer periods of time. All of this
And
would be
security and
appreciated.
safety.
Absolutely.
And you can sell products or redeem your units and the money comes within 3 days.
Absolutely.
You try and sell a flat,
Absolutely.
it's impossible.
So people, once they get used to this, they see the benefits of this. As one popular investor said, "Sab nafe ke daru hai," right? So when people see that benefit, they would start warming up to this entire concept. And
Now, I'm so glad we're having this conversation, and I'll just wrap up today's interaction with this whole message that it is important to take that leap of faith. Money is lost in market not when the actual correction occurs, but when you're really waiting for the correction.
Yes.
So good news and good prices rarely come together. Yes, you may miss few stocks, markets may remain volatile, but the joy of life is perhaps to look at market going up and down rather than a flat line. Right? Wonderful having you. We're very excited to partner with you in this investor initiative program. And at ET now we're committed to this cause that we will champion and help you reach your financial goals.